The major indices are showing resilience, but not outright aggression. The S&P 500, the SPY ETF, nudged up just plus 0.16% to $695.16. The tech-heavy QQQ is barely ahead at plus 0.08%. This tells us institutional money isn't rushing in, but they certainly aren't fleeing either. Now, look closely at the smaller capitalization stocks. The IWM, representing small caps, is showing real muscle, up plus 0.49%. This is a classic sign of risk-on appetite bleeding down from the giants into the broader economy. When the small guys lead, it suggests investors are willing to hunt for growth outside the mega-cap safe havens. But here's where the story gets textured: mega-chart divergence. While TSLA shows enthusiasm, rallying plus 0.89%, and AAPL adding plus 0.34%, the titans of productivity, MSFT and AMZN, are slightly in the red, down minus 0.44% and minus 0.37% respectively. This isn't panic, it's rotation. Money might be moving from established software giants toward areas perceived as having immediate, tangible momentum, perhaps linking back to those whispers of AI infrastructure deployment we'll discuss later. This quiet consolidation on the indices, combined with the jump in volatility, captured by the VIX, which is up plus 4.35% to 15.12, suggests underlying anxiety despite the positive price moves. The VIX is the market's fear gauge, and a rise here, even on a slightly up day, means participants are paying more for protection against sudden downside moves. It's like a quiet crowd where everyone is subtly checking their exits. The narrative landscape is dominated by politics colliding with economics, particularly around the Fed. We have the recurring tension involving Donald Trump denying involvement in any DOJ subpoenas concerning the Federal Reserve. When political figures cast shadows on the central bank's independence, even via denial, it creates a background hum of uncertainty for markets that thrive on predictable policy. This uncertainty echoes in the commentary from global leaders. Christine Lagarde, as Europe's Mrs. Crisis, is reportedly worried about the rise of populism. Populism, regardless of its origin, often translates to unpredictable fiscal policy, which rattles the stability that global markets demand. On the corporate front, the titans are wrestling with AI's gravitational pull. Jensen Huang of Nvidia is center stage, likely presenting at SAY 2026. Keep an eye on those keynote details, as they set the tone for hardware adoption. Simultaneously, Michael Burry warns that AI is turning big tech into a worse business, a fascinating counterpoint to the exuberance. And then there's Cathie Wood, who sees a sleeper AI opportunity the street is missing. It's a tug of war, the builders, Nvidia, versus the value skeptics, Burry, with innovators, Wood, finding the niche cracks. We also see shifts in leadership structure. BlackRock trimming 1% of staff under Larry Fink suggests efficiency drives amid market volatility, while the looming question of succession at JP Morgan hangs over Jamie Dimon's departure. These structural moves are the quiet operational adjustments happening beneath the daily price noise. And finally, the crypto figurehead Michael Saylor isn't pausing, buying another $1.25 billion in Bitcoin following an MSCI indexing decision. This links the world of institutional asset allocation directly to digital assets, legitimizing the climb we see in BTC/USD. The bond market provides the crucial context for the equity picture. The benchmark 10-year Treasury yield, TNX, has moved higher, ticking up plus 0.38% to 4.19%. This is the fundamental knot we must untangle. Higher yields mean a higher discount rate for future earnings. When bonds yield more, holding risk assets becomes less attractive unless those assets promise significant growth now. The fact that major indices are holding steady despite a rising 10-year yield is the key signal. It suggests that market conviction in earnings growth, perhaps driven by AI investment or economic reopening narratives, is strong enough to override the rising cost of capital. Investors are absorbing the higher hurdle rate. If this yield continues to climb rapidly, the rotation we see, small caps up, some tech slightly down, will accelerate as money flows from growth stocks sensitive to discounting back into shorter duration assets or those promising near-term value. Inflation remains the shadow hanging over every policy decision. We are prepped for the U.S. Consumer Price Index (CPI) release, which FX Street suggests will show steady inflation for December. Steady inflation, in a healthy economy, is good. But steady inflation, when yields are already elevated, puts immense pressure on the Federal Reserve. The recurring theme is the debate surrounding the Federal Reserve's independence from the White House, highlighted by PBS coverage. Market stability relies on the perception that the Fed can make politically unpopular decisions, like keeping rates high, without interference. Any perceived weakening of that independence introduces a geopolitical risk premium into asset pricing. Across the pond, we're tracking the ECB interest rate environment, with Statista looking at future projections. If inflation remains sticky in the US while Europe struggles to match growth, as suggested by the Atlantic Divide commentary concerning Europe's stagnation, the EUR-USD exchange rate, plus 0.36% to 1.17, will continue its narrative of dollar strength, albeit with minor fluctuations today. The dollar index, DXY, is essentially flat at 99.02, showing a momentary pause in that currency battle. Commodities tell a story of divergence between energy confidence and metal weakness. Crude oil, CL equals F, is showing confidence, rising plus 0.59% to $59.85. This often signals expectations for robust industrial activity or perhaps geopolitical supply tightening fears that aren't yet reflected in immediate inventory data. In stark contrast, gold, GC equals F, is down minus 0.37% to $4,587.40. Gold traditionally acts as a hedge against inflation and geopolitical instability. Its retreat suggests two possibilities. Either the immediate inflation fears are receding, or the rising treasury yields, making non-yielding gold less attractive, are outweighing safe haven demand. Given that the VIX is up, the yield explanation is likely dominant here. Investors prefer the 4.19% return on a treasury note over zero-yielding gold right now. We see clear evidence of rotation within the equity market today. 1. Tech leaders, NVDA, MSFT, AMZN, NVDA is flat, plus 0.04%, while MSFT and AMZN show modest dips. This is profit-taking or a temporary cooling off after intense focus on the AI infrastructure build-out. The headlines hint at competition, Meta's AI infrastructure initiative and Altman's positive news for Google, suggesting the race is intensifying, which can lead to choppiness for the incumbent infrastructure providers. 2. The consumer, industrial spread. Tesla's strong plus 0.89% performance shows enthusiasm for specific EV narratives, contrasting with the slight drag on broad consumer staples, evidenced by the Wells Fargo downgrade on Clorox, CLX. 3. The infrastructure play. We have headlines focusing on infrastructure rivals, CoreWeave, and quantum computing allies, QBTS. This suggests that money is actively searching for the next layer of technological foundation to invest in, moving beyond just the software layer. The digital asset space continues its remarkable trajectory, decoupling slightly from the S&P's mild performance. Bitcoin, BTC-USD, is up plus 0.81% to $91,930, and Ethereum, ETH-USD, leads the charge, up plus 1.05% to $3,124.83. This strength is directly attributable to the institutional validation we mentioned earlier, Michael Saylor's continuous buying following MSCI indexing news. When indices incorporate assets, it forces passive capital to buy, creating a fundamental demand floor. Ethereum's slightly better performance suggests strong conviction in ongoing development and utility, perhaps tied to decentralized finance ecosystem health. This isn't speculative noise. This is structural absorption by legacy finance architecture. The market is poised on a knife's edge, waiting for the CPI data. If CPI comes in higher than expected, expect the 10-year yield to spike above 4.20%, putting immediate downward pressure on growth stocks, QQQ, high multiple tech, and potentially strengthening the dollar, DX. The VIX will likely spike further as fear returns. If CPI comes in lower than expected, we could see yields drop, equity markets rally broadly, SPY, IWM, and the current rotation pause, favoring the large cap tech names that were slightly down today. We are also watching the headlines regarding productivity and the job market structure. A headline like, "Productivity can be another name for a rough job market," suggests underlying economic weakness might be masked by headline job figures. If investors start believing the job market story is deteriorating, it brings the Fed back into focus, potentially shifting sentiment rapidly toward rate cut expectations, a scenario that would boost both equities and gold, likely reversing the current bond yield trend. Today's market snapshot is one of cautious rotation under yield pressure. The overall story isn't panic, it's reweighting. Investors are shifting capital out of the most established, heavily valued software giants, MSFT, AMZN, and into smaller, high beta growth plays, IWM, TSLA, all while keeping one eye glued to the bond market's rising cost of money, TNX. The digital asset class, bolstered by structural indexing, continues its upward march, demonstrating a clear bifurcation between traditional economic growth indicators and the digital asset narrative. The dots connect here, higher yields signal higher required growth, and investors are currently backing specific tech segments, like AI infrastructure and crypto, to deliver that growth, while showing skepticism toward the broader stability of the established tech oligopoly amidst leadership transitions and existential warnings from figures like Burry.